Morning, ladies and gentlemen. This is Brad Matheny again, and I wanted to go over a little bit of something special, talking to you about what's really going on in the market. We've had a couple of things take place over the last basically 40 days. Number one, we've had a big shift in the election outcome, right? So we know that the election outcome is something very unusual and very unpredicted. Everybody had Harris as the potential winner. Trump comes out sweeping the swing states and everything else and ends up sweeping into the next president, the next election cycle, the next presidential cycle. But on top of that, we've had the Fed lowering rates in preparation for what they probably see as constraints going into the economy. Now, the Fed weakened rates about a month ago, and then weakened rates just, I believe it was last week. But what you're not seeing in the underlying is this mechanism here of trending. So pay attention to this trending. So now let me kind of just show you this upward trending, and we'll get rid of this, which was a measurement of the peak. I'll move it over here. And you can see this upward trending. Where did my line go? Oh, it's down here somewhere. Come back up here. I'll just try to draw another. Let me see if it does it again. Yeah, it moves it down there. I don't know why. Okay, we'll just try to draw it up here. Try to get it parallel. There we go, close enough. And there's our little upper channel, right? Looks like it tightens just a bit, so I'll move it there. There's our parallel channel. Now, on the downside, since basically 2022, this is September 2022. Now, remember, Fed started raising rates back over here. End of do it right, end of 2021 into 2022, we started raising rates. And this was the shift in money supply. This is what this is. This is all about money supply. And now we've moved into this contracting money supply for quite some time. Now I'll go right off these highs, make this red, and try to get a parallel channel down here. About like that. And we can actually come in maybe, well, I'll just go to these lows for now. But what I want to point out is the shift. Look at this shift. I mean, we have seen a dramatic upturn up into the upper channel. And you can see right here, you take a look at this upturn right here, right there. You see that? To me, that is a substantial shift in the market related to money supply. I had mentioned when last I showed this chart setup that the Fed was attempting to lower rates to stave off a potential crisis pending around global debt and credit markets. I believe that the Fed is making a move to try to provide additional liquidity, potentially for global banks related to the carry trade, global economies, particularly the biggest economies on the planet. Excluding the U.S., that would mean most of Asia, and that would mean quite a bit of Europe, and potentially others. The stronger the U.S. dollar is, the more likely these nations are having issues with regards to carry trade. Now, where we're at right now is the SPY has really rallied. So this is a custom index, but this is gold. And look at how gold, I'm going to convert this to a, where am I here? Just see if I can come in here and there we go. Style, candles, up, down, border, wick. There we go. So now you can see how gold has just absolutely collapsed. Okay, this is in relation to not necessarily what's happening in a market, but what's happening with the strength of the US dollar and with money supply. Okay, we need you to think of this as a shift is taking place, whereas the U.S. dollar has become exceptionally strong right now, putting pressure on global currencies. I guarantee you that many global currencies are reacting to this very, very harshly, and we're going to end up in a scenario where carry trade issues are going to become a problem in over the next 30, 60, 90 days. Think of that as foreign governments being able to settle and manage their debt, as well as foreign corporations and larger debt holders. And I want you to understand that, a lot of people borrowed very cheap dollars back after COVID in 2021 and even in early 2022. That's a lot of what happened with the Silicon Valley Bank and some of these other banks that have been failing. They bought into very, inexpensive bonds, low yield bonds, 2.5%, 3.5%. Now, bond yields are probably pushing 7.5%, 8.5%. So these purchases of these 10-year bonds back in 2021 at 2.5% held their value a little bit until early 2022, when all of a sudden rates have now increased. What this does is this puts pressure, this rallying mode here puts pressure on the Fed. So put this way, to raise rates. We have to contain the predatory US dollar and predatory strong US economy. Now, this is going to be an issue where um, relative containment, that's what the Fed is trying to do. So, Fed is attempting to contain a strong US dollar, US economy that presents a what I call predatory Fed action. And here's how that works. Okay. The Fed, in order to prevent a an increasing money supply scenario, prompting more inflation, prompting stagflation through the world, potentially, must attempt to raise rates. In order to do this, not Fred, in order to do this, or the reason they need to do this is because they want to try to contain the damage that can be done. Understand that, the real damage to the US economy with a stronger dollar is going to be, hard asset depreciation. You're going to see, I don't know how to put this any other way than to say that you're going to see, with a strong US dollar and a relatively strong US economy in a stagflation type of scenario, you're going to see inflation pricing continue to ramp up while consumers are squeezed. And what will end up happening is we'll end up seeing prices moderate. They will devalue, or what I would call revalue, over a time frame. And that's what I call a hard asset. It reminds me very much of what happened in the early 90s. So we had some strength. The markets weren't horrible. Inflation wasn't bad. But what we ended up seeing is relatively a hard asset revaluation. Interest rates weren't horrible. They were a little high in the early 90s. And if I remember right, around 7.5%. And the housing market contracted by about 35%. Was it a horrible contraction? No, it was a mild contraction. People just were squeezed. They just couldn't afford pricing. So houses came down, other things came down, oil prices came down. And in fact, let's go ahead and add crude oil in here. CL. See if we can go all the way back. New pane. And let's just go all the way back, see how far we go back into the 90s. I doubt this goes back very far. Okay, it does. Perfect. So we come back over here, and you can see back here in the 90s, look at crude. Peaked up here, and then we had this deflationary cycle. And you see it, this kind of a channel up into the 90s, really carried all the way over. I mean, you could say it carried all the way down to here, but this is the scenario of what I believe is actually kind of taking place in the markets right now. We're entering into this same type of environment. What happened to gold in the 90s? Well, look what happened over here. We ended up trading a bit sideways for a number of years. And you can see that we ended up seeing gold really struggle to kind of get out of its own way. Now, in my opinion, we didn't see a lot of risk to the global markets here. So I give you an example. There was a currency issue. You might remember it, the Asian currency crisis. You know, if you look that up, you'll find George Soros was involved. There was a moderate currency crisis in this area, 91, 92 through basically 94. This presented a bit of a crisis. You can see how gold reacted to it. You can see how oil reacted to it. And you can see again up here how we moved into this stagflation kind of a trend. Okay. We eventually broke out of that trend, really, you know, back over here. This is where we started to break into higher monetary money supply. And this actually came into play right during the start of the hype of the dot-com bubble. So the dot-com bubble carried us into here and then into the 2001 area, which is where we have the 9/11 attacks. And you can see here the big growth in the markets taking place over that same time frame, while we had gold contracting and while we had crude oil contracting. We didn't start to see all of that shift until after the dot-com bubble burst, which sent gold up. And then we moved into the 9/11 crisis, which started this move in gold. This is gold down here. Started a very big move in gold that lasted for 20 some years. Well, until 2011. So it lasted for 10 years. Now, where I think we are is we're shifting through this type of transition. Seeing as though we've been going down, now pay attention to this as I move over here. Seeing as though we have been going down in monetary supply and we're getting this hook, we're getting gold reacting and we're getting crude oil weakening. So what we're looking for here, guys, is this continued weakening of, and I'll try to draw it out over here, continuing weakening of oil, which may prompt a moderate weakening sideways trend into maybe April, May, June. I don't know. I'm guessing here on the timeline because I think the Fed is going to have to react. Now, gold will, in my opinion, recover and possibly go back up into this 20, I think 2840, 2860 area over the next couple of weeks, probably 30 plus days. But ultimately, the Fed, if the Fed does not act appropriately, then we are going to create this expansionary mode, putting pressure on the markets. Okay, and it's going to be a pretty solid bubble phase for the SPY until we see the Fed start to take steps to curtail this inflationary trend. Gold may struggle, but should react into as I mentioned to you before, into a breakout phase. So we have moved from the setup phase. Let me come back over here. We moved from what I called the setup phase, which, if I remember right, was this kind of a move, into what I called the breakaway phase, which was this kind of a move, into this area here, maybe a little bigger. And now eventually we will move into what I call the expansion phase, which should be coming right in here around June, July 2025 and lasting quite a while. Now, the expansion phase is going to be quite big. I'm going to try to draw this, drag this down because I need to be able to see where I'm at. There we go. So the expansion phase is going to be quite big. The breakaway phase, which is where we're at right here, is pretty much already done. Okay. This is pretty much already done. And the setup phase back over here has already completed. So this is the setup. And I've done many videos on this. You can check this out. This is the breakaway. Oops. And this is the expansion. So now, once we get past expansion, then we're moving into parabolic trending. This is where the real crisis starts to play out. And I drew expansion too big. Expansion should end around late 2027, maybe a little earlier. So once we get past expansion, this is where we move into very solid parabolic trending for gold. Really just blasting off. And I think this is where you're going to see gold move to 9, 10, 12,000, maybe even higher. But the consolidation of this move post presidency, I need you guys to pay attention to the concept that we need to watch the Fed. Okay. US Fed. I believe the Fed is going to be pushed to raise rates. If this trending continues, if this rolling expansion continues, I think that the economic numbers are going to show very moderately strong growth of inflationary trends, and the Fed is going to be forced to move in the opposite direction, raising rates potentially a half a point, potentially even more. And I think that's going to carry into probably more of a meltdown period here at the end of 2025 going into 2026. So with the Fed raising rates, trying to curtail this bounce that's happening here in money supply, I believe that we're going to see gold roll potentially and then expand very strongly into this expansion phase. We just have to wait this out. This is going to be a very volatile period through this transition, given what the Fed is doing. Now, remember, gold will, I'm going to modify this, make this yellow. Gold will act as a global hedge. So understand that if we start to see this expansionary money supply break above this trend channel here, let me minimize some of these. So that's crude oil. This is gold. This is my custom SPY. It's actually a custom index setup. And this is my money supply. If we see the money supply roll higher up into this area over the next early portion of 2025, the Fed is going to be forced, in my opinion, to act aggressively to stabilize this inflationary trend. The reason being is it will put extreme pressure on the global markets, okay? And the Fed cannot lower rates to work our way out of this, in my opinion. Now, the Fed could attempt to lower rates to try to make things easier, but it's going to push the markets into a greater stagflationary period. So really, we're getting into this shift, and the Trump presidency is doing it. The Trump win is what's causing this shift, and it really puts an issue, a crisis mode, potential crisis mode, coming into play in about 8 to 12 months, in my opinion. Right now, I think we're going to be able to weather our way through it. But this puts a lot of pressure on the markets. It really does. I don't think maybe some of you do, maybe some of you don't. banks, corporations, particularly foreign corporations that were borrowing cheap money to try to facilitate operations, ongoing global credit debt markets, the strong US dollar, and the strong US economy, in combination with the fact that the Fed may be pushed to keep rates relatively elevated, could push a very hard asset revaluation phase over the next 12 to 18 months. And that could be something fairly contagious, almost like a pandemic, but on hard assets. Think of it this way, guys. So people borrow money normally to buy assets, right? Copper, real estate, whatever, machinery. If hard assets revalue based on these rates and these low demand, because it's going to create lower demand for processes and for the economy. So it's going to maybe set, certain items lower, because demand, I mean, certain items will stay the same, or moderately hold up. But I'm thinking about, relatively core elements, but consumer expenditures are going to be, in my opinion, weakening. You're going to see weakened trending if this holds up for the general consumer going into kind of a protective phase. That to me means that houses, cars, core elements are going to be put under pressure. So you're going to see that people aren't going out and really spending a ton of money. I mean, I talked to a guy yesterday. I had my oil changed, and he told me he just bought a 2017 Nissan Sentra from somebody, a friend of his at CarMax. It was a trade-in. He bought it for $3,700. 2017 Nissan Sentra had 140,000 miles on it. But again, there was a time right after COVID that car would have gone for maybe 11 grand, 12 grand, and he just got it for 4 grand. I think you're going to see some real big shifts. And I'm trying to prepare you for this because we're not seeing my crash index start to move downward. This is a daily index, as I mentioned to you. I would be looking for this to roll down into this 68, 70 area on a bit of a contraction. So kind of like we saw right here, contraction and contraction. Notice what happened to the Dow Jones. We saw this contraction and we saw this contraction. So we're not seeing it yet. We are in this upper boundary area, and I do think that we're going to be looking at some moderate contraction, and that could send the Dow into a downward trend into 2025, early 2025. Could be my anomaly event setting up. We'll see. But what's really concerning for me here is the fact that gold, and I'll go back to daily here, gold right now has come down considerably off of this strength in the US dollar. Sorry, this is not the Dow, this is the dollar. But the strength in the US dollar here needs to subside. Okay, we need to get the strength in the US dollar down around 103, 104, 102, and try to keep it there to allow foreign debt markets to be able to operate efficiently or moderately efficiently. So be aware that we're not there yet. Okay. We have yet to get there. And with the strength of the dollar up into the 106, 107 territory, we're pushing. This is a reactionary move in the SPY. I believe that this is all going to revert back down into a normal structure. So I tried to draw this, which was an envelope period going back over 380 days. I think I set it for. But again, a normal structure, in my opinion, if we just carry these out, roughly puts us right in this area. 70, 71 for the crash index. And that would indicate a reversion of the SPY back down. It would indicate a reversion of the dollar down to about 103, 104. And it would mean that gold would hedge the risk of this reversion moving back up and then back up even higher. And I believe we're going to see gold move up into the 3,000 area plus before the first quarter in 2025. So we're really looking at this type of oops, got to remember to turn those Discord messages off. So we're looking at this first quarter in 2025. Oh, that's December. Let me move it over here. We're looking at gold really trying to move into, redraw this. I think we're going to get up to about 2,900, bouncing, 2,900, rolling, and then rolling into that 3,000 area at or before the start of 2025. It makes sense to me that gold will react to the pressure put on the market by this move. I'm looking for the base bottom in this hedging position to be closer to December 10th through 15th, which puts us right in this area. This is Christmas, just so you know. So right here would be Christmas. I think we move into this consolidated phase of the market, bottoming just before Christmas, 4, 5, 6 days before Christmas, maybe, and moving into a very solid rally phase. So again, I'm going to give you guys this heads up. This, when I did my original research for the anomaly event, I didn't quite have an idea of what it may be. I told you guys it looked like it was going to be related to hard assets, and I told you guys it looked like it was going to be related to financial banking and finance. Now, after a little bit of clarity, seeing how the dollar's moving, seeing how the markets are moving, seeing what's actually coming into play, I think we're looking at a moderately broad crisis event related to the extreme strength of this move in the US dollar. And I think it's putting a lot of pressure on foreign markets that we're not seeing yet. And again, I think it's going to become very critical with regard to hard assets over the next 2, 3, 4, 5, 6 months. So be aware that I think you're going to see the Fed really, really have to dance around an open fire, trying to figure out how to readjust and recalibrate for this shift in the Trump presidency. And I think it's going to get even crazier after the election. I don't know what Trump's going to do with regards to his first objectives, but I would imagine that the first 5, 6 months of 2025 are going to be fairly difficult for the markets to gauge. So again, pay attention. The reason I'm doing this is to just highlight this move. I mean, I was looking around, reading news articles, and I came in here and I'm just amazed. This is weekly. Look here daily. I'm just amazed at this move. Right through the presidency, right on up to this upper boundary. This is really, I'm telling you guys, this is a big move. This is a very big move to the upside. We haven't seen anything like this back over here in 2023. We saw a little bit of a reversion, but and this was a moderate sized move here, but we're moving in. This is almost like the Fed has gone to zero, and people are just expecting a blowout rally here. So again, I would urge you to be very cautious of this move. If we get above this red level and continue to trend higher, I'm going to say that the Fed is actually well behind the curve right now, and are really probably sitting down and having very serious discussions about what is likely to happen in the market. And they may try to let it settle. We'll see if the pressure subsides a bit. But this move to the upside, I didn't expect this. I figured it would take 6, 8, 12 months for this to start to roll out of this bottom and come back over here to weekly. And you can see, my drawings are that we were going to get this rolling out of this in 2025. This particular move here indicates that we're seeing a very big shift, and now we could end up seeing it really. I mean, I don't think it's going to skyrocket, but we could see it coming up into this area and really putting pressure on the Fed to address a stagflationary period in the markets. So again, trying to keep you guys ahead of what's going on. It's going to make for some good moves in the market. But, stagflation and global crisis events are what is likely to be happening over the next 6 months if we see this continue to move higher. And I'll keep you abreast of what's going on, but watch the Fed. Watch what's happening. Watch how the Fed reacts to this. Gold and silver will recover, looking for a bottom. But again, it may take us all the way into, I hate to say it, but it may take us all the way into March, April of 2025 before we get into the expansion phase. So, and the expansion phase should be, I drew this around 3,000, but it should really be more like 3,400 is the low. So I'll come up here and here we go. Roughly 3,400 is the low, and going up into the 5,700 high. So once we get up into this expansion phase, this will more than likely be back over here where if I come up here and draw, this will be the Fed, this thing coming up into this area, and then the Fed aggressively trying to deal with this by potentially raising rates. And then I think we're going to see this move back down. And we will see gold in the process roll up considerably and then into the expansion phase before we get the breakout. The breakout will probably come before this 2026 timeframe. See, I've got this drawn way too long. So it'll probably be right in here because then we move into that big expansion phase. This move, once we get out here, I'll just draw this. Once we get out into this area, this is where that parabolic move in gold starts to pick up. So that's going to be like first quarter of 2026, in my opinion. That's where the big parabolic move in gold takes place. And that's where we will likely be moving into more of a crisis event over here with regard to the global markets. So hypothetically, when we move into this area, we are going to have this mode right here. I've kind of drawn it. I'll draw it again. Oh, no, go away. This area right here, come in here, post expansion. So right in here. That's the area I think that we are lining up for some sort of a moderate crisis event. Everything else over here is minor. This is really minor, just dancing around the fire. This is more like dancing around the rim of a volcano, and we'll see how it plays out. So again, follow my research, pay attention to what I'm trying to tell you. I do this long term to try to give you ideas of where the markets are going to go so you can play it out. I believe this volatility is going to come to a fairly quick end. Come back over to my SPY chart. We've got the temporary bottom today pattern. We've seen a pretty decent low here in the markets. Remember, I drew this as we were going to get a lower pattern right here, this green level, rolling potentially back up. I doubt it's going to get way up here. It's more than likely going to be kind of like this, back up into this area. And that's going to be about it for today. And then we roll into more of a breakdown pattern tomorrow, which could end up being, again, kind of, more of a breakdown mode. and we'll see how that plays out for tomorrow. But again, follow my research. I've done a lot of research on this, and I think the Fed is, like I said, I think they're having deep, hard discussions right now about how to address this little breakaway, and they should probably pay attention to my chart, this chart, and let me explain to them why you're moving, or we are moving into a almost guaranteed stagflation period, and the Fed needs to work efficiently to keep rates at a point where the global markets can operate. And again, they may not like it, but they have to be able to operate efficiently. That's one of the things about the global markets is, as we've reconnected after 2021, 2024, roughly, and a more global market environment, everything is now tied to one another. So what the Fed does can affect, Turkey or whoever. And again, we're at a point where, as I mentioned to you, that I think over the last 3 or 4 years since COVID, the Fed has actually been operating. I call it dope walking into a predatory Fed moment, and I think that predatory Fed moment is coming pretty quickly right now. So buckle up. 2025 should be a lot of fun, guys. Okay, talk to you later.